I think unquestionably, if you ask me like to make a prediction, even though I said I wouldn't, this is a bubble of some sort. It's all going to fall apart in some way.
Well, I agree with Michael that eventually AI will be a bubble. But when people say something's a bubble, it's probably not a bubble. It's going to be a bubble when we say, of course it's not a bubble.
Hi, everybody. I'm Liz Thomas, Head of Investment Strategy at SoFi. This is the first ever live recording of The Important Part. We are so excited to be here at the lovely green space at WNYC in New York City. So I want to start this by saying markets, as everybody knows here, markets have been on a tear for quite a few years. The last few weeks being perhaps the exception to that, but quite a few years markets have been on a tear, largely due to AI, which has driven a ton of innovation. It's driven new products. It has injected a ton of money into the system. But there are investors all over the place sort of looking over their shoulders, uncomfortable, uneasy, something about this doesn't feel right, it's going too far, too fast, all the worries that we have about it. So when we think about that and look at what might be happening, you ask somebody like Tom Lee, and he'll tell you it's because we're at this juncture of great innovation and change, and that can be scary, but it doesn't mean that things have to fall apart anytime soon. So Tom Lee is co-founder and head of research at Fundstrat, a research firm known for its equity and economic research. Tom, thank you for joining me tonight.
Thank you. Glad to be here.
And Michael Lewis has been writing about times like this for decades, built his career telling stories about times when money is moving fast, people think everything is about to change. You all know Michael as the New York Times bestselling author of Moneyball, The Blind Side, The Big Short, many other titles, Going Infinite, all these titles that we know and love. So Michael, thank you for being here tonight.
Thanks for having me.
Everything you hear tonight is for educational purposes only. None of this is a recommendation to buy or sell securities on behalf of SoFi. So I'm going to start, Tom, with you just to sort of open this up. You have been a bull for a long time. You're sort of characterized as bullish, generally speaking. Why aren't you worried right now?
One thing, an adage that came from Art Cashin, the late Art Cashin, is that bull markets don't die of old age. They get killed by the Fed. So something to keep in mind is that just because stocks have done well doesn't mean that they can't continue to do well. And I know we'll cover this in our conversation today, but I think in 2026, we are starting to see the other side of the payoff from AI. And it's creating winners and losers. And I think that we are getting a policy shift from the Fed, which also is a tailwind. So I think in many ways, there are reasons for people to want to buy stocks this year.
And what's going on right now, I mean, we've seen even in just the last couple of weeks, right? Software stocks down a ton, crypto down a ton, and we'll get into crypto a little more specifically later. Does a period like this start to freak you out? Does it change the thesis at all?
Well, I think many people in the audience have been following this story for the last 2 years, which has been AI, like as a juggernaut. People already have exposure. But as Liz pointed out, there is something that's different this year. All of a sudden, a lot of stocks and industries are starting to have shrinkage. So the software industry, for instance, is seeing shrinking demand and a repricing of their service. And there's now many research reports pointing out that agentic AI products or AI products are starting to replace traditional software. And then, as you know, there's even stories of technology employment has shrunk in the last 3 years. Since the introduction of ChatGPT, it's a shrinking share of employment, and college graduates' unemployment rate is now higher than non-college students of the same age. Now, that is like what you might think is the bad news story, and that's what's the headlines right now. But think of it the other way. That's productivity for the economy. This is how you measure productivity, is that you produce more output with less people. So that's proof that AI is productive. software companies sell services to corporations. If they're spending less on software, which they are, that's a margin story. We're starting to see the benefits of AI.
Okay, so Michael, you've written numerous times about periods where markets are unstoppable and then they suddenly stop, right? They crash. And something I talk about a lot is before every crash, there are signs or some form of excess, some sort of excessive risk taking. What have been the common threads of excessive risk taking that you've seen through some of those stories? And then follow that up with, do you see that today?
All right, so it's funny because I don't think ever in my career have I come in before a collapse and figured out it was happening and then sort of kind of predicted it. What I do is come in sort of at the end of the battle and shoot the wounded. You know, if you think about all that happens, and then I happen to be kind of proximate to it in some way. That's true in a weird way, it's true of Liar's Poker, my first book I ever wrote, right? But it was certainly true of, I was writing about the internet bubble, and I wrote about I came in after the financial crisis of 2008 and found a story to tell there. Like, I just want to make it really clear. I have no idea what's going to happen, right? I mean, no idea. And I actually don't think anybody does. I think that you can tell stories either way. And I think it's like, what I do with my own money is largely just keep it in index funds and just assume I don't know what's going to happen. So having said that, it is true that after some of these events, these cataclysms, I do find people who did kind of figure out what was happening before it happened. They don't do it twice. So this is real. Let's take an example, because I think like people are thinking now. We just reissued The Big Short as an audiobook, and so I went back and I talked to all the characters from The Big Short, and they were really smart in the way they thought about the subprime mortgage crisis before it was a crisis. There were reasons why the people who got it right, but they weren't like, oh, they're globally right all the time. They were right in that moment for particular reasons. And, none of them have really predicted much since. They're all great. They're all smart. I love them all. They're all friends. But like, if they said, oh, Michael, like the market's going to collapse tomorrow, I wouldn't believe them. It's like, I just don't. So I think it's you got to be really careful.
I think that's interesting though, because then because we obsess over, Michael Burry posts a tweet, and everybody's like, "Oh my gosh!"
So I had him on I had him on my show just and the show that went along with it. We released a podcast with the audiobook, and to talk about like what he's thinking and what he said, and it tells you something that created this little crisis in the stock market. When he said he was short. What was it? It was Nvidia and Palantir, and I got him on to talk about like, all right, why. And what's the trade? And he's really interesting. Like, and he may be right, and he's got a story, and his story has to do with where we are in the capital expenditure cycle, and he mapped it onto other bubbles. And his story was he thought those were the two most inflated, but he said he doesn't know exactly when it's going to happen, but he was calling it within 2 years. So what he had done, he hadn't shorted them. And the position was not nearly as big as got reported in the press. He bought put options, long-dated put options, 2-year puts. He says, if I'm right, it's going to all happen within the next 2 years. And they were way out of the money puts. So it was very cheap. It was a very cheap thing to put on. So even though he came out and said that, the last thing he would do is like short Palantir. He doesn't know what it's going to do day to day, and he's like and this is part of a larger portfolio of bets he has on. And I don't think it's like maybe he's right, maybe he's wrong. So you asked me a question, I didn't answer it, and so I did a really good job.
What are the common threads of excess that maybe happened in some of those stories? So let's think about
out. That's the first thing. Fear of missing out. It's Going Infinite, the book I did about Sam Bankman-Fried. You think about how Sam Bankman-Fried happened, it was like fear of missing out. Like 180 venture capitalists threw money at him without asking to see exactly what he was doing. And the business was actually quite good, but that he had the money in the wrong place. They should have known. And you just saw that, especially the way markets behave and careers behave these days. Things can happen in a flash. People's fortunes change overnight. Companies' fortunes change overnight. There is the feeling that if you don't grab it, you're gonna miss it. And so that creates like act before you actually know very much. And so that's big. That you see that everywhere, right? And if you talk to the traders, so when I went back to do The Big Short, and I don't want to talk for too long, but I don't want to overstay my. You cut me off, but I'm going to quickly tell this story.
Okay.
So I thought when I wrote Liar's Poker, I was like non grata on Wall Street. No one would ever talk to me again. And for about a decade, that was true. When Wall Street collapses in 2008, all these firms start to go down. I thought it was just so interesting that the smartest money supposedly in the world, these big Wall Street firms, were on the wrong side of the massive bet that was going on in the world. They were all basically long subprime mortgages. And I got kind of traders out to talk about, I'd call up the guy who bet $50 billion for Morgan Stanley on the subprime market. And I get him out for a beer. And they'd all say a couple of things. One was, it wasn't my fault, everybody was doing it. So like it would have been dumber, it'd been dumb not to do it because everybody was doing it kind of thing. And the second thing they said was the reason they were talking to me was they had read Liar's Poker and it made them want to be traders. And so I thought, Jesus Christ, I created this crisis after a while. Like the wrong people, and the wrong people got the signal. But when you dug down into why they had done what they had done, in fact, they were paid a lot of money to do stupid things. That if they had missed out, they'd have missed out on several years of big fat bonuses that never got clawed back. So when people are giving you advice and people are doing things, you kind of think about what are their incentives? Like, why are they saying what they're saying? What is the motive here? And so that's the other big thread is like incentives get screwed up, and in these things. And I think unquestionably, if you ask me like to make a prediction, even though I said I wouldn't, this is a bubble of some sort. It's all going to fall apart in some way. It reminds me a bit of the internet bubble in that there'll be some things you were really happy you bought that are still going to go up, but they're going to be things that come crashing down. And the other big thing is the way it reminds me of the internet bubble is that they're conflating the technology with corporate profits. Like just because the technology is transformative, it doesn't mean that people are going to make a lot of money from it, or that everybody's going to make a lot of money from it. It may in fact be a machine for reducing corporate profits, or it may reduce some corporations' profits and increase other corporations' profits. But it isn't just because if AI is everything people say it's cracked up to be, if it's that great, it doesn't mean that there's a whole lot of money to be made in the stock market from it. It doesn't follow necessarily. It might, but it's not necessary.
Okay, so a couple of things. That's a great start.
Good.
Yes. Mm-hmm. So a couple of things that came up in that time. I know you're going to have thoughts on this, and I want to give you a chance to respond to some of that if you want to. But the idea of FOMO, all these acronyms we have, HODL, whatever, all the other ones that I'm going to sound like an idiot if I try to say. But it's this retail versus institutional theme, right? And throughout this entire cycle, since COVID, since we had, all the Johnny Newcomb traders that started during COVID, retail investors have gotten a lot right. And institutions in some of those periods have held back and haven't done the same thing. So first part of the question, how has retail gotten it right? Why have they been right? And second part of the question being today, who's calling it right? Because there are still some differences in positioning and just thought processes.
At Fundstrat, we have two sets of customers. We have our institutional research business, which is about 400 hedge funds, and then FS Insight, which is more family office RIAs, high net worth. It's not cheap, but it's about 10,000 subscribers. And we survey them every month, but we ask them for their top 5 favorite ideas and bottom 5, both institutional retail. And we have done this since 2019. The retail guys are getting it right. So their top 5 stocks do really well. We're even debating whether to make it an investment product. I think the reason they get it right is that they're not, to Michael's point about incentives, they don't care about daily P&L as an existential issue or like a weekly P&L. I mean, they want to get it right in the stock to work, but they're really working with permanent capital. Like it's their money. So they're willing to own something for 2 years, 3 years. When I started in the business, institutional investors used to have a 1-year time horizon, and that was considered like long-term. Today, most institutional investors have 30 days as their time horizon. And as you know, the average stock is held for like 40 seconds. So most, like, these large hedge funds, I think that they don't, 1 second or 5 seconds is considered a long holding period. So a lot of funds are literally just churning through stocks. So I think that's why institutions have a very narrow set of things that work for them, and it means that they have to buy liquid names that work right away. And as you know, like that's like finding a really narrow set of opportunities, whereas retail investors are just trying to find good ideas.
Do you think that creates more FOMO though, right? So if retail's getting it right, institutions then have to sort of chase into it to keep up. Doesn't that just drive the whole system?
Yeah. Or it's usually a battleground stock, like Palantir is an example, or Netflix in the mid 2000s. Like, when that was like $2, $3, $4, then $10, $20 stock that was heavily shorted by institutions but bought by retail. And then, as you know, a very famous one was GameStop. But I think names like Palantir, even Tesla, were battleground stocks where retail was a very big supporter. Institutions tended to use it as a source of funds. And then not only does FOMO happen, but there is usually a break point and the stock can re-rate higher. And that happened, as you know, in Tesla, and I think it was 2017 when it got added to the Russell 1000. So I don't know. I've seen retail get a lot of names right. They got a lot of names wrong too, but...
Can I ask you a question? That was interesting what he said in the very beginning.
Sure.
You said, what do you mean you're going to make a product of? You're going to make a product of what retail investors are buying?
Yeah. So we've got 60 months of what they rank as best ideas versus what they don't like. And then we have battleground stocks, which we know, let's say hedge funds think is their least favorite idea, but retail likes. Uh-huh. So we could offer something where people have access to, here is an ETF where every month it's actually buying what retail thinks are the best ideas.
Right.
So it's like a curated version of Wall Street Bets, because, on Reddit, Wall Street Bets is anyone can contribute. Right. But ours is a paywall. Like you have to be a subscriber and be part of our family. And then we get your ideas. So in a way, I think it's going to sort of have a sniff test, because it's not a bot. It's not some agent in like some other Eastern European country posting a post. It's actually one of our clients.
Oh.
So retail versus institutional on the gold trade. And we could even talk about the silver trade too. But the gold trade in particular, Tom, I'll start with you. My take on gold is that it had started as mainly an institutional and central bank trade. Then it did so well for so long, right? It outperformed the S&P for a couple of years. People were like, what in the world? This is not supposed to be happening. I had been pounding the table about gold a couple of years ago. People thought I was like, grandma and her gold again, right? But then it worked. And then retail started to get into it. I remember walking to the New York Stock Exchange to do a CNBC show one day, and GLD, the gold ETF, was ringing the bell, and they had like a fake gold bullion outside the stock exchange. There were gold flags everywhere. It was like, retail's in this now. So talk about the appetite between institutional and retail and gold, and your take on gold and silver and just metals in general, because they've become, I won't call them meme stocks, they're not, but they've become speculative assets. And then, Michael, I think you know where I'm setting you up. I'm teeing up the story for you.
Well, gold's been a great performer. I mean, I think if you look at a 25-year period, you've done better owning gold than owning the S&P. And it's probably a demographic story, because at Fundstrat, we do a lot of demographic work, and we found that preferences skip a generation. So like RV sales actually skip a generation. So it's every 50 years when you get another peak in RV sales.
RV sales?
Yeah.
Every 50 years?
So during COVID, you had a peak in RV sales.
Uh-huh.
The last time RV sales were that strong, Lucille Ball was on TV.
Oh my God.
So it's usually like kids So kids don't buy what their parents like, but they buy what their grandparents like.
Oh,
Interesting.
that is it.
Right, makes sense. Because like motorcycles aren't cool if your parents ride it, but if your grandfather did, like you see an old picture. And motors, like, so Harley is follows that too. But gold was really a big investment for the boomers. And then Gen X actually allocated to hedge funds and alternatives. So it's more the millennials and Gen Z that are buying gold. So it kind of makes sense that it's a generational trade taking place. Gold's become big. You know, gold is a network value of 35 trillion. The S&P X Mag 7 is 40 trillion. So today the gold market is almost as big as the stock market.
That's wild.
Yeah. So if
Is that the market value of existing gold stock?
Yeah. So no, above ground gold.
Above ground gold.
So there's 7 billion ounces of gold.
Okay.
Times roughly 5,000 is 35 trillion.
I start feeling greedy just talking about it. Yeah. Don't you? Don't you see? You start imagining it, and your palms start to sweat. Saliva starts to come into your glands.
Having that
Give me some
experience.
of that gold.
But there are some kind of things just to keep in the back of your mind about gold, because I like it. You know, I like to study things and understand, like, because gold is a Lindy effect asset. Like, it's been a store of a Lindy effect asset is something that, because it's been agreed upon as a store of value, for instance, that the longer you agree it is, and gold is centuries of it, you'll still accept it as a store of value. So because gold was always a medium of exchange, we just accept it as a medium of exchange. But the idea was gold is scarce, and just there's a couple what I'd call black swan risks to gold. One is there's 1 million times more gold underground than above ground today. And so if gold gets too expensive, like literally Mag 7 is just going to get into the gold mining business, right? Because like you might as well just dig for gold. It's more valuable than anything. The second is gold is all extraterrestrial. I learned that at the Perth Mint, which is one of the few places that assays and makes gold bars. So SpaceX might do a mission to Mars and then run into a gold asteroid. And Elon Musk, if he, it's international, I mean, he would own all the gold. He would become the new central bank. And that gold could be, 100 billion ounces.
What about the risk that you can manufacture it?
Correct. And the third is, of course, alchemy. Because look, if someone has discovered a way to knock an atom off lead to make it gold, they won't tell anybody. And there's just a whole bunch of gold supply coming. Because like all the lead is like disappearing and becoming gold. So gold is, it's a great investment. At 9,000, for instance, gold is bigger than the stock market. Like,
so is there a price that makes it not a good investment? Because we've heard, gold 5,000, 6,000, 7,000 even this year.
Yeah. So we studied this. So we looked at 100 years of gold to stock market capitalization. It can get to 150%, but then that's it. Like then gold's topped. Gold on January 30th fell 9% on one day. We looked back, there's only 3 other times gold had a single day decline more than 9%. And 3 times it marked a top for gold. So I don't know. I mean, but
if history is a guide.
Yeah, but if history is a guide, it's probably topped.
Okay. So Michael, you mentioned earlier that...
It wasn't a story. It was just like, what I told you that I own some.
I'm gonna set you up a little bit.
Why I own some.
So you mentioned earlier that you only do ETFs in your portfolios, sort of passive investments, but
just index funds, Vanguard index
occasionally you toe into other places.
Occasionally I lose my mind.
Okay.
Occasionally I think I have a thought.
Right.
And so, but this even wasn't even that. This is funny, but it involves a little backstory.
Okay.
You ready for the backstory?
Ready.
All right. So growing up, I grew up in New Orleans. Every week I had a poker game. Same group of 10 guys. And it was one of the guys was just better than everybody. He was just made to play poker. And his name was Bobby Klein. And he was one of my best friends. Lost touch with him after high school for complicated reasons, but heard, this takes us to the financial crisis, that Bobby was on Wall Street and that he was working for Bear Stearns. And Bear Stearns was in trouble. So I thought I better get back in touch with Bobby. just to see how he's doing. And I call him up out of the blue, and it was like it was yesterday. And he says, and I said, Bobby, I'm sorry, and he says, what are you sorry for? I said, well, you're at Bear Stearns. He goes, I'm not at Bear Stearns. I have a fund on the side of Bear Stearns, and I'm short the subprime market. So Bobby Klein had made the big short. And he had done very, very well for himself. And he then went in and created his own money management firm. 4 years ago, I was in his house, and he was showing me his coin collection. And it's a collection of old Roman coins. He has a world-class collection of old Roman coins. And he showed me the way the emperors debased the currency over time. And the silver content was less and less and less. And then he gave me a long argument for buying gold. And it was so persuasive. Like, I don't do that. I don't buy gold. It seems it's insane. I thought it was like insane. But I couldn't get it out of my head. And so finally, like 3 years ago, I bought a bunch of gold. And I just bought it, and it's just gone up and up, up and up. In fact, I called Bobby Klein a month ago and said, I feel so guilty. I made so much money from the gold you told me to buy. And I had never told him I did it. I said, could I just put some money in your fund? And he said, absolutely. So yesterday, I invested in Bobby Klein's fund. My money finally went into his fund. And what he's doing, and he's much smarter about this than I am, is buying gold mining stocks. It's a cheaper way to buy gold. And he acknowledges the Black Swan risks. I think he thinks the risks are lower than things like Bitcoin. I mean, and one of the that wasn't really a story. That was just like whatever. But how I came to own gold. But one of the things that did catch my eye, it was interesting. I thought Bitcoin was meant to be a threat to gold, right? Yeah. It's better gold. That was one of the stories.
Digital gold.
Yeah, but it started moving not like gold. It started moving with the stock market.
Right.
So it started to feel like something else. So gold it's amazing, and it is just a fiction, right? It's just we just agree to believe that this thing has value. And when I think of what I'm buying or owning, when I own it, I think I'm long fear. That's what I'm long. I'm long fear and anxiety. The uncertainty that's in the room right now. The uncertainty that's in the markets.
Armageddon trade.
It's like, okay, am I willing to sit with this now quite large gold position that's bizarre that I have? And I look around and think, I don't see really any reason not to be scared. I think fear is not a bad thing to be long right now.
Scared of markets doing something, or scared just in general of the world, the state
of the world will affect the markets.
Yeah.
I feel like we're a very unstable political situation. There's risks of lots of bad things happening, and I don't think it's going to go away anytime soon. And I think that fear is going to percolate. So I'm happy still owning it. And even if it went down by 60%, it still was a great trade. But I don't do this. This is not like, don't go do this, because I did this, one night when I shouldn't have done it, and it just worked out. Usually that's not a good investment strategy.
Right.
Yeah. I usually just assume I don't know where.
But it might be, Fidelity did a published report about the best performing retail accounts at Fidelity, and it was all customers who died. So in other words, they stopped trading their account, and it actually went up a lot.
Don't do anything. They just sat there with yes. Yeah, that's very funny.
The message is not die. The message is
there's an
don't
ETF,
overtrade.
There's an ETF for you.
Yeah.
Why don't you create an ETF of dead people?
Right.
Dead people's investment decisions.
Yeah.
Oh, okay. We're going to get this back on track real quick here. Let's talk about AI for a second. Tom, you've talked about the AI build out that we're seeing as, everybody's comparing it to the late 90s, early 2000s. You've compared it to telecom and in the late 90s, and you've said you think we're still in the early phases. So if that's true, let's assume that that's true. Some of the differences right now, all of the CapEx spend that's happening, it's bigger than it was in the 90s. It's a bigger proportion of GDP than it was in the 90s. It's happening now, right? And I don't think it was quite happening yet at this phase of the 90s. Should we be worried that we are overspending on CapEx?
Well, I agree with Michael that eventually AI will be a bubble. But when people say something's a bubble, it's probably not a bubble. It's going to be a bubble when we say, of course it's not a bubble, and then it is a bubble. I was a technology analyst in the 90s, so I witnessed that entire telecom overbuild and fiber and the quest digging up in Global Crossing, laying fiber. I was at Salomon Brothers. So Jack Rubman was one of the folks that was instrumental in raising money. I think that to me was a bubble because every company and every analyst had to change their model to justify the valuations. So you went to single-digit cost of money, exit multiples of like 20 or 30. So the multiples went up over time, and the risk cost actually dropped. Interestingly, when the bubble burst, everything went down at the same time. Like there was no way you could differentiate. So if someone's saying, I'll ride the AI bubble, but I'm in like this vector that's safe, it's not true. The 7 parts of the ecosystem wireless, they all collapsed at the same time. But then what emerged from the rubble were the best performing stocks that we realized later, like towers were the big winner post the crash. They outperformed the S&P by, I think, 10 to 1, meaning you had almost 10 times the return. And the second best was pizza. So Domino's Pizza. So in other words, like whatever all the bankers were buying and ordering at night was a better investment.
I thought you meant an acronym.
Oh, no, I did too. I didn't know where that was going.
Yeah. Towers were
the tower stock. So these are the companies that built metal poles that you hung cellular equipment on.
Those ended up being good investments?
That was the single best investment return.
I had no idea you were at Salomon Brothers.
Yeah.
We were both at Salomon Brothers.
Yeah, I read your book, but I think subsequently, I was on the research side. I wasn't a master of the universe.
No.
Yeah.
Salomon Brothers had the smartest people. I mean, in the research department, they were just the smartest people I'd ever met. That speaks very well of you. You were in the research department of Salomon Brothers. Sad that firm went away, but so you're right. Like it's when everybody's saying it's not a bubble is when just but can I still be a little suspicious of it now?
Yes.
Okay.
I think we should all be leery, but it's not. But the fact that we're all claiming it's a bubble, that's why I believe it's probably not a bubble because we're already being prudent in our actions.
Right.
So one of the things, Michael, that gets said over and over again is this time is different, right? I am very much of the mind this time is never different, meaning economic cycles, business cycles. There are different drivers and maybe some of the circumstances of how we got there are different, but it always sort of ends the same way. And have there been times, I guess, in some of these stories that you've written about and that you've seen, that you've dug through, right, and met the players behind them, have there been times where it actually was a little bit different? Or has it actually just reinforced for you that, nope, it's never different, it's just this time it was credit...
What do you mean by it?
The crash.
The movements and the gyrations of the stock market?
The gyrations of the stock market, maybe, but more so the manner in which things go up and then crash. So
it's just more extreme each time is what it feels like to me. And it also feels that this is kind of tangential to the subject of your podcast, but the relentless focus on the financial consequences when actually the social consequences seem way bigger. Like whatever happens to the stock market happens to the stock market, but with AI, I mean, you talk to really smart people who know the technology, and some of them will tell you it's going to lead to human extinction. Like who cares what the stock market does, right? Right? If we're not going to be here.
Right.
It doesn't, maybe all our portfolios will do much better.
Maybe we should die.
Because we won't be making decisions anymore.
Maybe death is the way.
Maybe the death is the solution to all of our financial problems. That's probably right. But now I'm wary of those predictions, but it does seem... It seems like hard to avoid that this collision we're going to have with the disruption that's going to be caused by lots of jobs going away, and that it's that the people at Google, the people at OpenAI will very cheerily at the same time they say out of one side of their mouths that it might kill us all, so we ought to be really, really careful. We have to think hard about it. Though nobody seems to be doing anything about that. It's just like going to happen or not happen. Out of the other side of their mouth, they'll say in 18 months it'll be able to do everything a human does, but better. Now, let's forget for a moment whether it kills us all. If in 18 months it can do everything that a human can do, but better, what on earth is going to happen to this country? And people are already pissed off about the economy. We're living with the politics of anger for a stretch. The anger is going to go through the roof. Just seems like so much of a bigger event than whatever happens in the stock market. But I don't know that that's true. That in 18 months it's not going to be.
That seems fast.
And I don't know how. I'd be interested to know how you feel about this in your business. I don't really feel yet, honestly, a threat from AI. I don't feel like, it's just going to do what I do, and I'm not going to be able to do it. I've tried. I've plugged in, here, write me a book about Sam Bankman-Fried, or write me this or that, and it doesn't. All it knows is what's on the web.
Right.
It doesn't know anything. And it knows some things, but doesn't know much. It hasn't gone out and interviewed people. It hasn't seen and smelled and tasted and all that. So it's. Can I tell a quick little story?
Sure.
Okay. So
Tom said yes too. So,
okay. So when I was working on Going Infinite, when I was working on the book about Sam Bankman-Fried, I knew that he'd had some interaction with Sam Altman, and of course he had bought a 20% stake in Anthropic. One of the things he used customers' funds for was to build this actually pretty extraordinary venture capital portfolio, and so I thought I had to go see Sam Altman just to see his take on Sam Bankman-Fried and his plight. And so I went over to Sam Altman's house. And we had dinner together, just two of us. And it turned out that he, interesting guy, really fun to talk to. I had no strong view one way or the other about him going in, and I just enjoyed the evening. But it turned out he had a little bit of an agenda. And his agenda was, he had all these people who wanted to write his biography. And he didn't really want his biography written, but he thought if he could just pick one of them, and it would get everybody else off his back. So he wanted to talk to me about some of these people. And in the middle of this conversation, I said to him, if your machine is so smart, why don't you have your machine write the biography? Why are you having a person write this thing? You say this thing's so smart. Dump all your Slack channel stuff, dump everything in there, tell it everything, and you can tell it about yourself, and have it do it. And he said, it's not smart enough. He said, it'd be a really bad book. And I said, well, that's what I suspected, that is true. I said, well, when will it be a really good book? And he says, maybe a couple of years kind of thing. And we had a kind of agreement that.
So what year was that?
Where we left it was, when you think it's smart enough to write a really good book, I want to challenge it to a contest.
Okay.
That I will come back in, and we will pour everything into it. We'll let it write its book, but I'll do my book along the side of it. And we will just compare whose book is better. And
my money's on you for that.
Well, I don't know. Maybe, but it doesn't really feel even now it doesn't feel like a fair fight. It feels like this thing can do certain things, but I don't know. I don't know when it's going to be able to do everything. So people say stuff like, it's going to take your job in 18 months. And then people forget that they said it.
But isn't that the story every time? That every technological advancement, the internet was like that. It's going to ruin all the jobs. All this stuff is going to disappear. Hasn't it been the case that actually every technological advancement over time has created more jobs than it's destroyed? So is that, what happens here? Is that going to be the case here? And is it just a skills problem that the people whose jobs were destroyed then don't have the skills for the new jobs that are created?
Yeah, I think there's two historical examples that we can compare of job replacement. The first, you go back to the 30s, which is when flash frozen first got introduced by Charles Birdseye. At that time, 30% of the American workforce worked on a farm. But because flash frozen helped prevent spoilage and it completely transformed grocery aisles, food went from being 20% of the wallet to 5%. And farming employment went from 30% of the U.S. economy to 5%. So 95% of farmers were replaced. But that created time and innovation, the economy prospered, even though an economist would have told you in 1930 that we'd have another depression. But then, what happened with China taking over manufacturing is the opposite story, right? Where it gutted the entire entire states. And like people call it distributional consequences, but that was poorly planned because they didn't think about how to find new work for these people. So I think it is, like Michael said, pretty important to be thoughtful of the distributional consequences of what's happening. And then it could be a positive ending.
I never heard anybody mention flash frozen as an important moment in human history. And I actually never heard the phrase, but that's very cool. That technology had that kind of effect.
Yeah, and actually and I learned this from
Did you know
recently.
This?
No, I didn't. Tom, I didn't know Tom knew so much about farming and groceries.
You were just staring at him as like you knew that all.
Well, no, it was like
I never heard.
Where did he?
Yeah, so we did like studies on disruption.
Okay.
You know, whether it was like waterways and telecom, how it affected waterways. But East of Eden, in the end of the book, actually makes reference to flash frozen.
Well, that's right. That's what an interesting thing. Has anybody written about your studies on disruption?
No,
I don't need to be using this as I know it's trolling for material, but it sounds like very good material.
We shared it with our clients. I mean, we'd be glad to share it with you.
All right.
It's more like research report, so it's not a narrative.
It's all right. It's just interesting. It's like I never would have occurred to me that's what did it for farms.
Yeah, it's like the AI of the 30s, right?
Right. Yeah. It's a great comparison. I don't know. And what were the politics? I'm sorry, but what were the consequences? 30%.
Oh,
by the way, Flash Frozen was funded by Goldman Sachs. It was a venture investment by Goldman Sachs.
There we go.
Twist.
And here's what's interesting. Charles Birdseye was an ornithologist. He studied birds, and he was with the Inuit tribe in Alaska, and they served him fish, and he was shocked at how fresh it was. And they explained that they put the fish in like whatever salt water, and it was flash frozen.
His name is Charles Birdseye, and he studied birds.
Yeah.
All right.
Yeah. That's why, it'd be like Dr. Foot is your foot doctor.
Yeah, that's right. Yeah.
Okay, back to Wall Street just for a second here. Sorry to interrupt you guys.
No, but it's very important for investors to have a broad understanding of the world, right?
Absolutely.
To be curious about things.
Yeah.
Like to learn new things.
And you can invest in farmland, turns out. So, I mean, you should know these things. Michael, what surprises you about what has or has not changed on Wall Street since you started your career back before Liar's Poker?
It surprises me that people still read Liar's Poker. No, seriously, my daughter started on Wall Street 2 years ago at a well-known firm, and some older person who didn't know she was my daughter handed her Liar's Poker and said, "You got to read this if you want to know how the business works." And now I would, yes. And she said, like, "You're out of your mind. I'm not going to read his book."
Right.
You know, she's like, I don't like, no child of mine has ever read a book I've written. So that's not really wasn't going to happen. But it was, if you'd have asked me in 1990, a year after the book came out, would anybody still have interest in it? And 10 years, I said, no way. Part of what this story is about is rapid technical change affecting this business and like throwing lots of power to the youngins and disenfranchising the old ones because the old ones can't understand the business anymore. That was one of the things going on, and that the securities are changing so fast. I thought it's going to sound very dated very soon. And my audience, I assume, except for the media audience, was like 100 years from now, people will never believe that someone paid me all that money to give financial advice. Like it was an insane period on Wall Street. So the fact that there's something about the story that I lived that's still relevant, and I've tried. It's not obvious what it is because the markets have changed a lot. I don't think there's anybody doing quite the job I did. The bond markets are. The markets have been automated, right? So it's like everybody's operating in them with robot arms rather than actually a lot of human interaction. There aren't any strippers on trading desks anymore, right? All that's gone. The human interaction. So what is it that's kind of kept it current? And the best I can come up with is that it is still true that that world is ruled by young people. That what was weird when I started, and a little after you started, was the idea that you could come out of Princeton, Harvard, Yale, And within a couple of years, being paid at the time the outrageous sum of a couple of $100,000, it transformed the relationship between elite institutions and the financial system. A generation before, my father's generation, dumb people went to Wall Street. It was like the BC student who was like a good glad-hander. It was for sociable, clubbable people. It wasn't the smarties. The smarties went and did something else. And there wasn't a lot of money, right? You know, if you read The Great Gatsby, the narrator of The Great Gatsby, Nick Carraway, it's not a glamorous job being the bond salesman. So what happened was rapid change, increasing financial rents to the financial system, all the rest. All of a sudden gave young people a kind of purchase on the system they didn't have before. And then all of a sudden, half the graduating class of these schools want to do it. And that's still sort of true. It's not, it's now high frequency trading firms and private equity. And so that's one thing that's kind of kept occurring. And also, this knock-on effect of that is what it does to people's lives. Because of the rewards being so stacked early on in life feeling so much more front-end loaded. It was just starting to feel that way when I kind of came out of school. That you feel like you couldn't study what you wanted to at school. You had to study something that would be practical. You wanted to signal to Wall Street. And now you go to Wall Street when you're a freshman in college and you start to plan your whole life around it.
Right.
That kind of thing was just starting, and it's gotten more extreme, but it's the same. So that surprises me. I thought that was just going to end.
Hasn't it sort of ended, or at least transferred? And maybe, Tom, you can answer this one because you mentioned college graduates having higher unemployment than non-college graduates, meaning people without a degree. Isn't it now tech that's become the glamorous, that's where the smarties go? It's not Wall Street anymore?
My kids are all recent graduates of college, and I still have one in college. But when my daughter went to her school, and she wanted to be an art history major, but then she started to meet all these people, and she wanted to hang out with all the smart people, and then she found out all of them wanted to work on Wall Street. Okay. And so she joined like a business fraternity. So I think Wall Street still lures a certain kind of person, which is a hyper-competitive, wants to be with the best. And maybe that's why the culture still lingers. Like there's this influx of people that are aspirational. And and Michael is right, like to get into Wharton as an undergrad now, because I went there, many years ago. Like it's so hyper competitive that like high school students have to do business things to get into Wharton, whereas, you just had to demonstrate good interest back then, when I went there. So
it is true. There's competition for the smarties, for the particular kind of smarty. But a lot of you go to Jane Street, there are 25-year-olds making millions of dollars a year. I mean, it's gotten more so. It's gotten the rewards to young people who hit the market. It's gotten more extreme.
Right, the magnitude is bigger.
Yeah, I knew nothing, right? I knew I knew nothing, and it was amazing to me that knowing nothing, someone would throw that kind of money at me. It was no wonder that everybody was lining up for it, because everybody kind of senses when they come out of college, they don't really know that much, and there's this place that will throw all this money at you, even if you don't know anything. Of course, you're going to line up for it, and so that hasn't changed. It's just more, but it is true that the tech industry, that Silicon Valley, but a large part of that is finance. It's the venture capitalists.
Yep.
So you say, what has changed and what hasn't changed? The rise of the quant. The quant was an exotic creature when I started, and they were becoming the dominant force at a place like Salomon Brothers, but they weren't quite running the show. And now the quants run the show. That's changed, but I guess I would have thought, if you'd asked me way back when, that just the share of the economy that the financial sector controlled would have shrunk. That this was a moment, but instead it's just that the financial sector has just grown. I mean, if you just think about what technology has offered the world. The internet was meant to disintermediate everything. Like, we don't need travel agents anymore, and, that kind of thing. And you would have thought that would have taken Wall Street out of, it had that similar effect on Wall Street. Doesn't seem to have been.
Yeah. Well, technically, the financial industry is a mirror of the real economy. So for every unit of real, there has to be one unit of financial.
Yeah, that's
And digital is blurring it. In the last 20 years, 50% of all GDP growth was native digital. And that means like the money, like what's a service and money is really blurring. And in the future, like money is blurring because what's a reward or what's a creation versus a unit of dollar, or gold versus dollar versus a digital token, which means the financial share of the economy could actually be growing in the future. And then the role of the quant is going to be even more important.
Why do you think?
Quants really create a market. They create the liquidity to swap, like what's an Hermes bag versus a dollar, or what's a bond, or in francs versus bonds. Like all this is all what quants stabilize and provide the market for. And if more of the world is blurring what's money versus a digital good, that means the quants play a bigger role, which means Wall Street technically could make more money, or companies like JP Morgan become like technology stocks over time because they're not really lending, they're making markets, which is what service providers do.
Right.
Yeah.
Well, one of the things that has not changed about all of this is that headlines are still dominated by the Fed. And we recently had a headline about the Fed. We had a new Fed chair nominee in Kevin Warsh. So believe what you want about him, believe what you want about what we think his policies might be. The question I would ask you, Tom, is do you think once he gets, let's assume he's confirmed and gets into office, do you think it changes the era of Fed intervention? I'm not even going to touch independence, but Fed intervention, because he's believed to be against QE. Does it all change?
Yeah, I think you're bringing up a good point. I'm not a Fed expert, but I've, of course, tried to get up to speed on Kevin Warsh, who I've never met. But I know he's actually made public statements in the past that he believes the Fed has limited abilities to really help the economy. So what people tend to think is the Fed saves the economy, but they can really only do things like set interest rates and, of course, communicate and try to influence rates. And so it makes sense that if the White House is interested in limiting the role of the Fed, then Warsh is a good person to put in that place, because then the Treasury Department and policy coming from fiscal policy can then be more influential on the economy, whether it's affecting rates or creating and reducing spreads between mortgages and policy rates, or even direct intervention. So it might make sense, but the stock market didn't really seem to take his announcement very well.
And who knows, right? Who knows what the reason was? But I think maybe the bigger question, and Michael, I'll give this one to you. The bigger question is if the Fed has less of a role in markets because Kevin Warsh ends up in office, just generally speaking, even if we compare this to 2008 and The Big Short, right? Are we better protected today than we were then from something like that?
So I mean, ask him, like he knows much more. But I can tell you what my first reaction to this is. You said you weren't going to touch independence, but independence is what this
you
is.
can.
It's a big deal, right? And Trump clearly doesn't want an independent Federal Reserve. The markets keep scaring him into stealing it. He'd take it if he could. I mean, we wouldn't have an independent Fed if the stock market didn't collapse every time he said something about taking control of it. So there's that. Now, rewind to 2008. I think it's a hard argument to make. The Fed what they did wasn't extremely important in stabilizing the financial system and the economy. What they did was extreme. The people who did it were students of 1929, and the mistake the Fed made the other direction way back then. I buy that argument. I buy that it was a good thing for them to get involved. And I don't believe that if there's a version of that when Trump is in office, that he's going to tell the Fed, don't buy anything, stay out of it. That's not what's going to happen.
Well, let's imagine that the version is AI, the circular funding diagram starts to crumble,
Okay.
right? Some big player starts to fall apart, earning whatever it is. We can all
Depends on
imagine
what
this
it is.
scenario.
All right. Yeah.
Then does the Fed, either of you can take this, does the Fed come in and bail out AI companies?
I mean, Trump is not shy about using the government to do whatever he wants to make things look better. So I have a hard time believing that the Fed is all of a sudden going to become like this hands-off libertarian's dream. That's not who Trump is. I don't know. You think I'm wrong?
I think you're right. I think the Fed knows that they would pull out every toolkit possible to prevent, a collapse of the economy.
Right.
I mean, I think that's the lesson. Even a hawkish Fed would agree to that.
Right.
I think that if the AI companies start failing, I think they'll be nationalized. Because, I think that it's a race between U.S. and China. Like, I think that probably in their minds, this superpower today or in the 10 years is who controls AI and that ecosystem. And if the funding starts to falter, I believe that even the Defense Department has already wargamed, how to acquire NVIDIA or how many people they need to take out of Taiwan to recreate Taiwan Semiconductor here, right? So I think it's that important that they would probably nationalize the assets.
Isn't this weird cognitive dissonance going on right now? Because the noise in the air out of the Trump administration is government's bad. We're going to cut the government. We're going to the deep state, all this stuff. But what they're thinking, what they're using the government for, implies the government knows best. They're interfering with markets in ways that no Democrat would in recent.
Yeah, picking winners and losers,
that
right?
kind of thing.
Yeah,
it's amazing what's going on.
Yeah. Okay, I promised the audience we'd get to crypto.
How many people here own crypto? So pretty sizable number.
Yeah.
How many people here own gold? You should have called me. You should have called me.
All right, let's talk about crypto for a little bit. I think I'm going to go off script here too.
He's the expert.
I know.
Okay.
But you wrote a book about it.
I wrote a book about Sam Bankman-Fried.
And I know.
And I left a paragraph there saying, I'm not going to talk about crypto because it's been talked about enough. So I didn't actually, I don't.
We're still thirsty for it here,
okay,
Michael.
All right, okay.
So crypto today, when I looked today, it was Bitcoin, 72,000 something. Okay. At some point, very recently, it was over 120,000. So it's been a little bit of a fall lately. And I think the prevailing idea for a while had been, okay, the correlation of Bitcoin to the NASDAQ is tight. So Bitcoin is going to follow tech stocks. And then that sort of broke down. And the gold versus Bitcoin thing sort of broke down. What is happening right now? Is this a crypto winter? How long does winter last? What is going on right now?
I've been writing about crypto for about 10 years now. And Bitcoin is down about 40% from its highs, almost 50%. I think it's like the seventh time it's fallen 50% from a recent or local high. 3 of those times there were genuine crypto winters, like bear markets that led to a 90% decline from the peak. And so I think if anyone's been in crypto a long time, like this, we're kind of used to the pain, of these drawdowns. But there is a difference that it is, crypto will diverge from its narrative because it's evolving, like it's becoming more of an institutional asset. And there's questions about quantum now. And quantum is a genuine risk to Bitcoin in the sense that if quantum supremacy really becomes commercial, and maybe in China they've already figured out, about a quarter of Bitcoin wallets can actually be, that's the bounty, they can be stolen because, Satoshi hasn't upgraded his wallets. But I think that this is probably more of a crypto squall, not a crypto winter.
Squall.
Yeah. So we're in a painful drawdown. Part of it was triggered from October 10th because on that date there was a price shock, which was the Trump proposing new tariffs on China that triggered a whole cascade of deleveraging in the crypto industry, bigger than the FTX deleveraging that happened in November 2022. November 2022 basically marked the end of that bear market. And that's when things like transaction activity began to recover. The reason I don't think we're in a crypto winter is that things like, if you look at Ethereum, daily transaction activity has actually been rising parabolically because of tokenization. And, Wall Street is starting to build on crypto. So in some ways, I think crypto just suffers from the fact that gold's done so well that it's sucked away risk appetite from everything else. And there's no leverage in crypto, and people who want to do 0-day trading and high frequency trading, it's really paid to buy gold and silver right now.
I got a question.
Okay.
I want to know what the Black Swan event is for crypto.
Yeah, I think there's a few. So one is of course, if quantum can break encryption.
So what is it? What will that do? It means you won't be able to. Your Bitcoin will never be safe.
Yeah. So Bitcoin itself will need to do, unless they can somehow push and upgrade into the old wallets, which they can't. They'll have to fork Bitcoin to a quantum resistant chain.
And so the old, like Satoshi's wallet, will just be.
Yeah. So all of a sudden, like the lore of Bitcoin is kind of broken, right? Because you're abandoning Satoshi's Bitcoins.
Who's Satoshi?
That's a different podcast.
I am sorry about that. Sorry about that. I thought maybe he knew. I thought maybe he knew who Satoshi was.
Yeah.
Okay.
But like things like Ethereum, they upgrade twice a year, so they can develop quantum resistance. I think the second risk actually to crypto is AI, in the sense that today the narrative is like AI needs to start to engage in microtransactions, because like robots, when they get into the wild, you can't keep it in a walled garden, so you have to validate transactions. And of course, they have to collect money. And so blockchains can sort of track all this, and they all have digital wallets. And by the way, if you generate enough tax revenue from that, you don't have to employ Americans anymore, because like the government tax receipts will be big enough that people don't have to work. I mean, that's probably one way to at least create a financial safety net. But what if AI gets so smart that they're all running their own blockchain? And so you don't need public chains because AI runs their own language of validation. And so you don't need crypto because the AI, as you know, like I know Moltbook is a fake, but you know how like AI is developing their own language and places to linger. If they're developing their own social language, they could always develop their own monetary system. So
what's the likelihood?
Where they put Kevin Warsh in charge of it?
Oh gosh.
Well, the AI version of Kevin Warsh, right?
What's the likelihood of those Black Swan events?
It would be a question of like whether governments can regulate that structure and collect taxes. I think that's one of the big criticisms about crypto in the past, was that it was a way to maybe not be taxed. So I'm sure that's part of like the policy effort. But what we're seeing in crypto today, of course, is just really a traditional battle, which is incumbents which is Wall Street hijacking the narrative on crypto and the Clarity Act to kind of stack everything in their favor to try to quash the new entrants. But that's like an old, that's the battle we've seen in every new technology. But that's hurting public chains because Wall Street wants to sort of control the narrative.
I want to see what it looks like when AI gets pissed off because it's paying taxes.
Yeah.
They're going to want to vote, right?
Yeah,
they want citizenship.
The AI Tea Party.
Yeah.
I'm interested in what do you think Sam Bankman-Fried was doing right? Not that anybody wants to hear something redeeming about him, right? But
he was creating
what
great
did he
stories
get
as
right?
he moved through the world. So what did he get right? The big thing he got right was he created a crypto exchange that Jane Street and jump trading all us wanted to trade on. That he created the industrial strength crypto exchange. The exchange, I don't think, maybe I'm missing something, but I don't think anybody has questioned, even as investors, that the exchange really worked. I mean, one of the reasons it was he went undetected is people didn't imagine he jeopardized such a successful business. So he built, because he himself had been a high frequency trader, He'd worked at Jane Street. He'd traded, he'd gone into the crypto markets and saw how bad, kind of janky the exchanges were. He did create an exchange that was better. And I kind of thought when it all went down, no publicity is bad publicity, that FTX was now the best known exchange brand in the world. It was negative at the time, but I thought someone would buy it and resuscitate it. So that was one thing. Right is not the right word, but it's interesting. It's interesting. And I think sincere, this whole effective altruism movement, that he was part of it. He really cared about it. It sounds weird to say it, but all they talked about was, like the efficient ways to like make money and give it away. And so not right or wrong, but an interesting thing that was happening. And that it found its way into Wall Street. That Jane Street found itself worrying about hiring too many effective altruists because you couldn't control people who didn't want a third house in the Hamptons. That they were so used to that as the mechanism for like controlling the staff, that I want more for myself, that I thought that was interesting. I don't think we've heard the last from Sam Bankman-Fried. I don't know what's going to happen, but it's like a rule in life that wherever he goes, things get more interesting. Even jail is more interesting with him in it. I mean, he was in a cell with P. Diddy and that guy, the president of Honduras, and Luigi passed through for a day.
Oh,
and
gosh.
it was a sitcom.
Yeah.
He is, wherever he goes, the prison guards want crypto advice. The inmates want to help him fund his business, their businesses.
Do you still talk to him?
It's hard to talk to him. I visited him in the Brooklyn jail once. First time I went into Brooklyn was to go to the jail. And it's not that nice. I don't understand what people see in Brooklyn. But he writes a daily diary. And if there's a prison email system and you get on the email system, you can get the diary. So I read the diary. It's just like what life is like in prison. So,
well, we are over time. Tom Lee, Michael Lewis, thank you so much for doing this. We've got, thank you. We've got some audience Q&A. I'm only going to do one of them, if that's okay with everybody, because we're late here. So this is going to go to both of you. Some have argued that the boom in sports betting and prediction markets, as well as the emergence of newer asset classes like crypto, have served as outlets for speculation. Speculation that would otherwise be occurring in the equity markets. This suggests there's lower risk of froth in the equity markets. Does that have any merit? Tom, I'll send it to you first.
The crazy people are being siphoned off in the sports betting markets.
The crazies.
They're doing crazier stuff.
Well, couple things. I think prediction markets are actually really useful because it's the closest thing to a crystal ball. So we use it at Fundstrat, the aggregate data. And I mean, many of you may know, but Polymarket in 2024, we were using that to follow the election more than the Nate Silvers of the world. And Polymarket, called 50 of 50 states correctly. So the prediction markets in aggregate, got it right. But I think for users, it is a form of gambling. So I think there is a social consequence. Prediction markets and crypto, though, are starting to really help deconstruct like what a stock is. So I think it's really a big innovation for the financial industry because, in the future, for instance, like if you're going to buy Tesla stock, today you can buy Tesla stock and it's $400 a share. But in theory, Tesla could actually be factorized. Like, you can break it up into 36 or 20 different earning streams, right? Each future year. And someone, if it's tokenized, can just buy 2036 earnings. And that's the price of it. So management knows what the market's pricing for their earnings, but then it's a lottery ticket for you. Because if they beat it, it's because it's a cheap option, you could make a lot more money than buying the whole company. So I think that there's a lot of innovation coming. But of course, with that innovation speculation, it creates winners and losers. But that's capitalism, right? I mean, since 1974, 40,000 stocks either went public or were spun off. And 90% fell by more than 50%. And of the ones that fell 50%, roughly 90% went to zero. So in other words, like the majority of stocks basically go to zero.
On that note, let's bring it more upbeat with thoughts on prediction markets and just the speculation.
The question was, is it making the stock market saner?
Yeah.
And that's not obviously true. I mean, it sounds like a good thing, but it doesn't look to me like the stock market's saner than it was before sports gambling became legal.
Yeah.
I did a podcast season on sports gambling. It's the history of it's interesting, and the way the country has just flipped on this subject. The leagues, the sports leagues, just say this was the work of the devil, and it's now the Chiefs' engine of growth. It's corrupting sports. It is creating horrible incentives and you could predict, and we did predict, you could predict where the problems were going to arise. It's like college basketball games where the kids who are playing aren't getting paid a whole lot of money. There's a lot of money wagered on the games, and a single player can do things that affect the outcome of the game. You're seeing scandal after scandal, and it's going to keep happening unless they ban prop betting on college sports. So I expect the government is eventually going to catch up to this, but we're going to look back on a period of it was not good for the society. It's not fashionable to talk that way, and it's especially predatory towards young men. It's young men who do it. And overwhelmingly, it's a young male marketplace. My son, who just graduated from high school, all his friends in high school, in California, where it's illegal, sports gambling is one of the 12 states that don't have it, and they're all underage. They all have sports betting accounts. So you could predict what's going to happen there. And is it like some percentage of those people have real life problems because of they're doing this? And it's kind of funny now. So since we did the podcast, to see that FanDuel and DraftKings, who were really the culprits in all this, and there was a history to why they dominated the market, are now on their heels because the prediction markets are taking over their business. Because the prediction markets, those businesses got classified as commodities exchanges, and they're not regulated by the states. I think it's a bad thing. I think the prediction markets are great. I'm with you on that. It's really interesting. I like it that people can bet on politics, but I think the sports gambling, especially, that the society's going to have to get its arms around it, or it's going to ruin sports and ruin a lot of young men's lives.
Yeah. Okay. Well, we are over time. Tom Lee, Michael Lewis, thank you so much for doing this. For more from me, read my weekly column in SoFi's newsletter, On the Money, and on the SoFi website, or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Sony Podcasts.
Investments are not FDIC insured, are not bank guaranteed, and may lose value. Elizabeth Thomas is a registered representative of SoFi Securities, LLC, and an investment advisor representative of SoFi Wealth, LLC. SoFi Invest is a trade name used by SoFi Wealth, LLC, and SoFi Securities, LLC, offering investment products and services. Robo-investing and advisory services are provided by SoFi Wealth, LLC, an SEC-registered investment advisor. Brokerage and self-directed investing products offered through SoFi Securities, LLC, member FINRA SIPC. For disclosures on SoFi Invest platforms, visit sofi.com/legal. For a full listing of the fees associated with SoFi Invest, please view our fee schedule.